Good afternoon, everybody. An educated economist here. So this will be part 5 of the monetary policy strategies for a low neutral interest rate world, a speech that came out of the Federal Reserve Bank in New York, November 30th, 2018 by John C. Williams, President and Chief Executive Officer. And where we left off on in part 4 is we had basically come to the Fed had basically admitted that the interest rates are so low that there's no more firepower left. So like typically during a recession, when the recession would start to kick in, the Fed would lower interest rates, facilitating loans, right? So people would be able to take out loans a lot easier and cheaper in order to stimulate the economy. They go out and buy cars and houses and, you know, spend credit card debt and stuff like that. And the Fed has saying basically that there's no more firepower left, right? We've only raised interest rates up to 2%, and that doesn't leave us a whole lot of room to work with. And their first option here is to maintain the basic framework of inflation targeting and to rely on a combination of aggressive, conventional, and unconventional policy actions. And so basically what that means is that, you know, they have this typical inflation, you know, expectations that they try to shoot for. And if they can't get it, then they got to lower interest rates to hopefully get that inflation expectation to achieve it, right? To get this you know, to get the inflation, get the thing stimulated and moving, right? To get people to taking out the debt. And he is saying that since we don't have this much room, we might have to get into unconventional policies, which means that we need to drop the interest rates probably into negative interest rates, because that would be unconventional from what they typically do. So let's go ahead and read this, and then we'll go ahead and break it on down. The second option is the average inflation targeting, whereby the central bank purposely aims to achieve the above target inflation rate in good times when the lower bound is not constrained. Properly designed and implemented, such an overshoot can offset the inflation undershoot during bad times so that the long-run average inflation rate and inflation expectations are in line with the target. The third option is price level targeting, including its various offshoots, such as nominal GDP targeting and temporary price level targeting. In such a regime, the central bank commits to keep the price level near a steady growing target path like average inflation targeting. This strategy promises to overshoot the target inflation rate in good times to make up for the inflation undershoot when policy is constrained. In theory, both average inflation and price level targeting can solve the problem of anchoring inflation expectations at the target rate while maintaining low inflation target rate amid low neutral rates. Although price level targeting is a bigger leap from inflation targeting than average inflation targeting, each can be implemented in ways that are very similar to standard inflation targeting, either in terms of forecasting targeting or policy rules. Importantly, neither will likely be effective in practice unless communicated clearly and carried out consistently over time. More broadly, all of these proposed strategies face potential costs and benefits in terms of macroeconomic performance, communication, and robustness to uncertainty, which require careful study. In considering alternative monetary policy strategies, academic experts, policymakers, and others from around the world have an important part to play, sharing and discussing ideas, comparing experiences to help all of us think through these issues. The process of careful study and discussion proved highly valuable during the development and implementation of the inflation targeting in the decades past, and will be equally valuable in the present debates. Thank you. So if we go back up to the second option, right? So the first option, I believe, is that they're just going to kind of keep things rolling in the simple framework that they have, but actually go into negative interest rates. That's kind of what I read into it. I could be wrong. The second option is the average inflation targeting, whereby central banks purposefully aim to achieve an above-target inflation rate in good times. Well, that means like when things are hot and heavy and rolling, they're actually going to cause more inflation during that time, cause more asset, you know, prices to go up. That way, during the recessions and the assets prices start to fall, they'll actually fall down to where they should have been. So what happens to all the people who bought when the prices were at their high? They get screwed. Right? They get screwed out of that. And that's what they're saying. The second option is whereby the central banks purposefully aim to achieve an above-target inflation rate in good times. Right? Properly designed and implemented, such an overshoot can offset the inflation undershoot during bad times so that longer-run average inflation and inflation expectations are in line with the target. So that's what they're saying. They're saying that will cause the prices to go way up so that when they drop, they actually drop down to where they should have been. That's what I got out of it. All right, the third option is price level targeting, including its various offshoots such as nominal GDP targeting and temporary price targeting. In such a regime, central banks commits to keeping the price level near a steady growing target path. Like average inflation targeting, this strategy promises to overshoot the target inflation rate in good times to make up for inflation undershoot when the policy is constrained. So what he is saying there is that when the GDP or when the growth is starting to happen, to cause inflation during that time so that it can go on. It's pretty much the same thing as the average inflation. It's just a little bit different, you know, as far as the implementation of it. But it's essentially going to do the same thing, right? They want to try and create inflation ahead of time before, you know, so that when the deflation comes, it actually lands where it should have been. Goes in to say, in theory, both average inflation and price level targeting can solve the problem of anchoring inflation expectations at a target rate while maintaining a low inflationary target rate amid low neutral rates. All right, so basically what they are saying there, both average inflation and price target can solve the problem of anchoring inflation expectations at the target rate while maintaining low inflation target rate, or while maintaining a low inflation target rate amid low neutral rates. So that's what they're saying. If it's so low, then you know what? If we can't drop interest rates down, then you know what? How about we just fire ahead of time, right? How about we shoot and then hope the target lands in front of the bullet that we just fired? Because that's kind of what they're saying. They're saying we're going to cause the inflation ahead of time, so that way when things turn down, everything will kind of land where it's supposed to be. That's what he said. That's what he said right there. At least that's what I get out of it. This speech in itself is pretty telling. You know, I kind of thought about this for a second, and I was thinking, you know, if I was sitting in the room listening to this speech, right, you know, the guy was standing up there on stage, and he's sitting there spitting the speech out, there is no way that I would have understood anything inside of this speech. Not in one take sitting there listening to it. I just wouldn't have understood anything. Going back and reading it over and over again and kind of breaking it down, it starts to make a lot more sense. And what's tripping me out the most about this is that this speech was given to a group of policymakers. Right? It wasn't given to the American people. This is what he had to say for the American people. Now, this speech came out November 30th. December 4th, just what, 5 days later, Fed Williams, this came out, an article out of, I think it was Market Watch. Fed Williams, right? Strong outlook for 2019, calls for, calls for the continued interest rate hikes, right? And so it doesn't sound anything like what he was just saying. Because in that speech, just 5 days earlier, from talking to the mainstream media, his own personal thoughts, this is what he had to say. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. 5 days later, speaking on behalf of the Federal Reserve Bank, he says inflation will move a little above the Fed 2% target. So which one are you going to believe? You know, are you going to believe the one where he's speaking on behalf of the Fed to the masses, or are you going to believe the speech in which he was given to the rest of the policymakers? More to come. Thank you guys for watching part 5. I hope you all enjoyed that. I hope it really helped to kind of bring the idea of what the Fed is kind of going through as far as their thought process right now. What they are telling you and what they are talking about are two very different things. Okay, guys? So keep your eyes open, follow the money. I appreciate you guys watching. Please share the videos with your friends if you like. I really want to get this discussion rolling. You know what I'm saying? There's going to be some heavy times coming up. The Dow is screaming in different directions right now, right? Fed Williams came out, said they were going to raise interest rates, and Dow crashes, right? Powell comes out and says, you know, hey, we're coming up to neutral rates. We're thinking we're probably going to stop. Dow goes flying up in the air. The Fed only has to whisper a little bit about what they're going to do in the future, and it causes these huge market gyrations. Okay, guys, so don't fall into the hype. There is a lot. Here's a good, believe half of what you see and none of what you hear. Okay? Half of what you see and none of what you hear. Talk to you guys later.